Hey everyone, welcome again to the Wealth Preservation Podcast. I'm Mark Seither and I have with me Josh Saunders.
Good afternoon, everybody. How are we doing today? We're excited to be here. We are super excited to have extremely awesome tax strategist, Mr. Ed Cotney, with us. Ed is a family and tax wealth strategist, and there's probably few people that I know on the planet that know family succession planning and family tax planning better than Ed. So Ed, welcome. Thanks for being here.
Thanks, guys. Looking forward to our talk today.
Yeah, we're going to talk about some pretty interesting topics. Mark, why don't you kick us off and talk about the topics that we're going to be going over today?
Yeah, so we're going to go on. So last year, the Secure Act was passed, and there's some, some nuances. There's the main points you've probably heard from your financial advisors, but Ed's really going to dive down into some things that he thinks a lot of advisors are missing. We talked for maybe 10 minutes before the podcast, and I already have a headache just with all the information he just dumped on me. I'm glad I had some coffee to try and keep up with the full episode. But he's really going to dive into, hey, what are advisors typically missing? What should families be doing? And really it comes down to how much tax savings is lost just because people don't know, right? They're just totally missing it.
Exactly.
So Ed, let's take half a second and kind of let's take a couple minutes and go over your kind of background. Where'd you come from? And how did you get into this business? And how did you become a family tax wealth specialist, right? Am I saying that right?
Yeah, there's a lot of things going on there, and thanks, Josh. But yeah, I'm from Alabama, Roll Tide. We have a football team.
Really?
Oh, yeah.
You guys won the national championship?
Is it new?
No.
Oh, that's right.
We did not win the national championship this year. We ended up as number 2, which is unacceptable.
It's absolutely.
Yeah.
Nick Saban should not be happy.
I know. I mean, it's like, come on, Nick.
You have to win every year, required.
Thank you.
Yeah.
And why the other teams are even involved, I don't know.
Dabo Sweeney is overrated.
No, he's
a
great
kidding,
guy. He
Dabo.
graduated
He's
from
awesome.
Alabama at least.
He's kidding.
Great guy. We love Dabo. So if we're going to lose to anybody, at least losing to Clemson's good.
That's right. Yes.
But losing to Georgia, Tennessee,
Unacceptable.
Mississippi, LSU, those are painful.
So we might actually just talk about football today. It seems like that's a deep passion of Ed.
It is. The thing about being from Alabama is that, it's not a lot to do there, but you study football, play football, and watch kudzu grow, and that's about it. So I left Alabama when I was 18, joined the Air Force, had a great time, traveled the world, kept going to school, and it was a lot of fun, and then retired 20 years later, and then ended up in this opportunity where one of my water ski buddies says, what are you going to do for the rest of your life when you retire? And I'm like, I don't know, just not be gone. I was tired of being gone, you being a Navy guy, you know about being gone all the time, and I was just tired of being gone, and he's like, well, I'm going to sell my multi-gazillion-dollar business in a few years, and we're looking at a tax bill that would choke a horse. And would you be interested in going to tax school? Now, let's see, physiology degree, aviation management degree, flying, jumping. Yeah, obviously learning
makes
about
sense.
taxes makes sense.
Yeah.
So off to school I went back east and pretty much got my butt handed to me, but learned a lot about tax planning strategies and how the tax code is really designed that most people don't know how to use or do, including our tax attorneys and CPAs. The tax code is a very generous tax code. We're 80,000 plus pages now in federal code alone, and most of our professional advisors use maybe the first 200 pages of it.
Wow. Okay.
So there's a lot of great nuggets in the tax code, and which is one of the reasons why I wrote my book, Tax Secrets Made Simple, is to help families and even professional advisors learn about some of the little nuggets that can help the majority of people in this country learn how to pay less tax, because it is a process of unlearning everything that you've learned how to do wrong your entire life with money and taxation.
Right.
So it's just like any good financial planner or accountant or an attorney. We go to them to help them modify the way we think so that we can do things better.
Okay. I want to go back to your kind of that statement you made. Well, let's take one more step back. I'm sorry that you were in the Air Force. Flare to land, squat to pee. It's kind of how.
At least our crash rate is a lot lower. Navy guys, you guys can crash planes more, and it's okay.
That's true. We do, yeah. So for those of you who don't know listening, I fly airplanes still. I'm in the Navy Reserve still, and Ed was an instructor pilot in the Air Force for a long, long, long time. So it's good banter, inter-service rivalry back and forth. But Ed, before we kick, thank you so much for your service. It is appreciated from my end, and as I'm getting close to my retirement too. But thank you for your service, Ed.
Well, you're an American worth fighting for, but you're active duty too. So,
So I guess I should be the one thanking you guys.
You should. Yeah, exactly. Come on, man.
I did not join the military. Hanging out with Josh and my family has a lot of people in the military too. If I didn't know better, I would think everybody did it.
Right.
I'm always around people.
Except for Mark.
Except for Mark.
Yeah.
I just went to school.
Just school. But let's kind of step back to you're kind of doing your intro, and you said that most advisors use only about 200 pages of the tax code of the 80,000.
Yeah.
And why is that? What happened? Do advisors lose their brains, or are they just lazy, like you said, or what happens?
Well, it's not so much an issue of lazy. It's an issue of what works for me to be able to make a living.
Right.
And so regardless of what you do for your profession, it becomes an issue of what are the things I can do repetitively every day to have the most number of clients come into me so I can get paid to do my job.
Right.
And that is the stuff that's bread and butter. We need wills and trust and power of attorneys. We need an IRA 401k. We need a life insurance policy. We need to do our tax returns for our businesses and ourselves. And so the bulk of advisors end up having to focus their time and energy on the things that makes them a living every day.
Right.
Some of these higher, more advanced, nuanced strategies of legal and tax get to be interesting because now it's a lot of training and education experience and, to be frank, liability for a lot of advisors that they're not willing to take.
So you're saying that advisors are self-interested? Is that kind of what you're saying?
I don't want to throw all the advisors under the bus like that, but the reality is to do the things necessary to stay abreast of all the changes and modifications in advanced tax planning,
Right.
you have to devote a significant amount of your weekly time following where Congress is going with tax law, what changes in the states are working, and it just means that now you have less time to be productive to earn money.
Right. Yeah, to grow a business and
Exactly.
right. So it's really not the advice fault. It's just kind of how it's set up, and you only have so much time and hours in a week, and you can only
Correct.
do so much.
Correct.
Yeah. So that's kind of where you come in. That's kind of, obviously we've known each other for quite some time. Jeez,
Yeah.
It's been almost a decade now. Holy cow.
Wow.
Yeah. But that's kind of where you come in. You're kind of that, I would kind of call you my own personal estate planning guru or tax planning guru. I mean, I don't know how many times I've called you with questions and been like, hey, Ed, I got a situation. What do you think? And it might be a fit or not, but you kind of fill that gap, at least for me. Maybe that just makes me lazy, but I'd rather use smart people. Don't have to learn all that stuff. But you kind of fill that gap for me, and so thanks for doing that. But why do advisors miss some of that stuff besides just the time it takes to learn and it being easy? What else are they? Is there not the opportunities there?
The opportunities are there, but it's just time consuming and costly. And the mistake that I made, and I hate to cause it a mistake, but it was really a blessing. I went from being active duty military right into this fancy dancy tax school on the East Coast for about a year and a half. And I was so naive that when I left that school, I just assumed every accountant, attorney, and financial planner in the country knew how to do advanced tax planning.
Right.
And wow, was it a surprise? I mean, it was like the things that I look at today that I consider so basic and fundamental. Other people are telling me, "Oh my gosh, that's rocket science stuff," and I'm like, "Oh no, we hadn't even talked about rocket science yet. We're
Right,
just
yeah.
talking about very rudimentary concepts that can just save you 5, 10, 15% a year on taxes."
Right.
So there is an issue of being able to figure out what works, what doesn't work, and why, and how to apply it. And that's why when I wrote my book 2 years ago, I tried to look at what are the most common things that help people be able to take something from this book and apply it.
Right.
And so I have 56 different tax planning strategies to address issues, but all 56 strategies don't work on every single issue.
Yeah.
Or nature and character of asset or event or whatever. It's learning how to figure out of the issue at hand, what is the nature and character, and then what are the objectives of the client, and then how do we fit this in a tax code, both federal and state, to make this thing create the most wealth for the client and the least amount of tax. And I like to sprinkle some charity work in here, because if I'm going to give less money to the IRS, I prefer to give more money to charity.
Right.
And that's what our tax code really says, is that if you would rather bless charitable organizations more than the IRS, you have that right.
Right.
However, you have to get off your butt and get people around you to do it, because the IRS is not going to come to your house and show you how to pay less tax and give more money to your church.
What? Seriously?
They're not going to do it. Honest.
I thought they had a whole
We should
division that did
petition
that
for that division.
Yeah. Man, I'm calling my congressman.
Real quick for our audience. So if you're a financial advisor out there and you're thinking, "Oh, that's me. I should be learning more," you can find, if you're listening, it's Tax Secrets Made Simple. If you're watching on iTunes, or if you're watching on YouTube, then you can see the book. But quick, you can see this is not a thick book. I'm sure it just touches the high points of the strategies Ed is talking about. But it's at least a starting point where you can go, kind of learn these things that, Ed said some people think are rocket science, and he's like, this is not even close to rocket science. Like, this is just basic planning that everyone should be doing. So,
and I've read it. It's a great read. Good, again, like you said, Mark, a good starting point on where
Yeah.
advisors should start to kind of get this thing cranking and go from there.
Exactly.
Or lose clients.
Or lose
It's a free country.
Yeah, right. Or don't read.
Yeah, make less money.
Well, you do have the right to overpay your tax.
Yes.
There is no law against overpaying your tax.
That's true.
And like I said, earlier, I was like, hey, and some people are like, how do I pay less taxes? I'm like, well, you could make less money. You pay less
Yeah.
taxes that way, right?
That's definitely a strategy.
Yeah,
Yep.
Then my joke on ass protection is like, well, if you just give it all to me, they can't sue you for it. So, boom.
Also another good strategy.
Foolproof. I haven't picked up any clients with that.
That doesn't work. Well, cool. Let's. So, kind of this episode, like we talked about, was definitely going to be about the Secure Act, and go from there, and then some tax reduction strategies on the back end that the Secure Act kind of eliminated and started. We're mostly talking about the IRA stretch. But let's kind of go. Ed, can you kind of give us a high points of the Secure Act, and kind of what it changed and what it didn't, and we'll go from there.
Actually, there's a ton of things in the Secure Act which focused on just cleaning up administrative, technical, legal. Overwhelmingly, advisors across the nation are going, thank you, Congress, for giving us law that actually helps. In this law...
Good job, Congress, by the way. So
good
thank
job.
you for that.
Good job on this one.
Yay, Congress.
A lot of people are freaking out about, oh my gosh, they changed the RMD age from 70 and a half to 72. Well, most people truly don't want to take an RMD from their IRA anyway. I mean,
Right.
if we could have had this thing passed to 75 or longer, most of America would have said, great.
Yep.
The number one complaint I get from seniors is, I don't want to take any more money from my IRAs because they're already drawing Social Security.
Yep.
By the time they're 70, they're drawing Social Security. Now they'll start taking monies from their RMDs of their IRAs. And if the IRAs are kind of larger, the next thing you know, that other income causes part or up to 85% of the Social Security to be subject to income tax.
You mean the IRS might have planned it that way so that maybe you're going to pay more? What?
Really?
Ed, no.
Oh,
They would never do that.
No.
It was an
That's-
accident. Total accident.
Yeah, total slip up.
Yeah.
Yeah, I mean, and I'll give you a real world example. I mean, I have a couple of clients that are 70 and a half, thought they were going to retire, kind of half retired, hate being retired, or at least working.
Mhm.
They work less, they work how they want to, but they're still making money. And they had to take RMDs last year, or this year, I guess. Yeah, 70 and a half. And they're like, I'm gonna get hosed on this. I'm gonna pay a whole bunch of tax. I'm paying my top marginal rate on these dollars, and I really wish I couldn't take it. And luckily, we were able to flip around, and we could invest. They fully funded defined benefit plans. We could put money in there, but they had to take that money. It had to flow through and do that whole machination. But they had to write a check. We had to do it. There's nothing else we could have done.
Yeah.
So yeah, you're right. Most people don't want to take the RMDs if they don't have to.
They don't. One simple strategy that I get with a lot of folks who don't have a large IRA, but they have decent amount of money coming from Social Security and a couple of bucks coming from their IRAs on their RMDs, and they like supporting charitable causes.
Mhm.
One really smart play here is if you're over the age of 70.5, you can now direct part of your IRA to go straight to the charitable causes that you want to support.
Okay.
They do have to be 501c3s, qualified charities with IRS, all of that legal stuff goes here. But if you stop and think about it, let's say that I'm required to take $15,000 from my IRA this year and I'm 74, 75 years old.
Yep.
If I don't need it, and if I'm the type of person who's going to make a $4,000 donation to my church anyway, then instead of taking $15,000 taxable from your IRA, so that you can then give monies to your church to then get a tax deduction, not a credit,
Right.
you actually paid for part of this charitable gift. There was a smarter way to do it. So if my RMD is $15,000, let's just have my IRA custodian send $4,000 to my church, which has never been taxed,
Okay.
and then $11,000 comes to me. I only have to pay taxes on the $11,000. And then if I'm trying to figure out how my Social Security provisional tax rate is going to be adjusted, that's another play at the same time. So if I took the $15,000 RMD, I might end up with my Social Security more taxed.
Right.
Whereas here, I made the same gift. It's just, it was more beneficial for me to use part of the 80,000 pages of tax code.
Yep.
And how do
That
you
one's for
know-
free,
Yep.
ladies and gentlemen. That one is for
How do
free.
you
good
know
listeners.
Ed is a numbers cruncher? Is Josh and I say 70 and a half, and he says 70.5.
Yep.
Yeah.
Down to it's like 0.5.
Yeah.
Okay, so the big one is we kind of talked about Secure Act and 70 and a half RMDs up to 72.
72.
That's one. What else is in there?
Well, everybody wants to know, how do we pay for that?
Okay.
Well, Congress always has to figure out a way to pay for this. And so the way they paid for this was they changed the rules on what happens to our IRAs when we die, commonly caused when it's a distribution, not to our spouse, but when our spouse and ourselves die,
Okay.
the money goes to a non-spousal beneficiary, in other words, our children. What Congress did was they took away one of the tools that we have been talking about using for years called the stretch option election on an inherited IRA. And so what Congress did is they made it so that when our children inherit these qualified plans, they can no longer let this thing be stretched for their lives. And so they put a cap on it, 10-year cap. So when mom and dad die, and that IRA now becomes an inherited IRA, they shall take all of it out at some point, whenever they want, between now and 10 years.
Okay.
There's no RMD rule. It just let it all sit there and wait for 10 years, or take out what you want today and some next week and some in 2 years. The new rule is that IRA shall be fully closed and distributed 10 years after the second death.
Okay. So
that's how we put more money in the IRS's hands so that we can pay for the lack of RMDs not being paid to people that are 70.5, 71, et cetera.
Yeah.
So there was a tax play here, revenue model for the IRS. But the reality is they're really going to be collecting some major bucks here because they're put that cap on here. But to put things in perspective, I've done several seminars this year on this topic, and
I just want to dive into that. So for everybody listening, it went from you could stretch. How long could you stretch it before? What was the option before?
Was it like to 85 or something? I mean, it was a ton of years. And we used to be able to show these charts that if mom and dad die and they're 75 and they leave like $1 million IRA to little Johnny and he's like 55.
Sure.
And if little Johnny takes just the RMDs, because it's a different RMD table for the inherited beneficiaries, which is it's a fraction. I mean, it's a teeny weeny fraction.
Yeah.
And so if we just left the money under management, the compounded growth inside of that tax-free vehicle while it's growing is just phenomenal.
Right.
And so we'd have these charts where it just turns into a rocket at the end. And so $1 million would turn into several $1 million over time. But nobody was doing it.
Yeah.
You know, 1 out of 100
you had the
kids.
option. You had the option at least.
You had the option.
Yeah.
And anytime the kid wanted the money, they can just say, I want the money, because they technically own the plan.
Right.
It's theirs.
Them changing the tax code, and so now you have a 10-year cap. That's basically all you can stretch the IRA out is 10 years. That's our cap, right?
Inherited IRA, 10-year cap.
Perfect. So the problem with that is what problem does that cause, or what does that fix? At least as far as the inheritor, right? Or for the tax planning strategy.
It made things actually simpler.
Okay.
You know, because now we don't have that required minimal distribution stuff. Because remember, if you don't take the RMD, there's a 50% excise tax penalty. I mean, a lot of accounting things just got simpler.
Okay.
Here it is. You got 10 years. Use it, basically. So most folks are really focusing on, oh my gosh, this is a huge problem. It's not. Out of the 5 seminars that I've done in the first 2 months of this year to 163 advisors, East Coast to West Coast, I asked the question, how many of you manage qualified monies? Well, everybody.
Yeah.
How many of you advisors manage monies for clients that husband and wife have died and it became an inherited qualified plan? Well, about a third of the room, each place I spoke at. And then I asked the question, I said, be honest. How many of you have managed a stretch option IRA for an inherited non-spouse beneficiary for more than 10 years? I had one hand from one advisor who had one client. So even though we have talked about this stretch option concept for years, trying to convince our clients who created these plans with the theory that their children could control the tax exposures by letting the money be stretched out over a long period of time, technically it's not been happening. Now, I'm not saying it's not happening at all, but it's just that the majority of the time, I would comfortably say 95% of the children who inherit IRAs, they get about 2 years out of it.
Right. So to kind of encapsulate the problem is that you have children that inherit IRAs. Let's say it's $1 million IRA. Most of them, and I've kind of seen this personally in our world, we have some clients that did this. They inherit this IRA, and the kids have all the best intention of making that money last and saving it for their grandkids if they want to. And within 2 to 3 years, it's gone.
Yes, sir.
And again, I'm not saying that is bad that they spend it. Some of it is legitimate. I mean, they paid off their house or put a kid through college or whatever. And those are good expenses.
You really can't tell them, no, you can't take the money.
Right.
You're showing them the better way, or not. I don't want to say the better way, but the growth way. You're saying, hey, this could become this, and if it's not worth it to
them. But the problem is when they take that money, correct me if I'm wrong, when they take that money, it becomes taxed at your marginal tax rate, your income tax rate.
Yes, added on top of the money your child earned.
Right. So if you're a person, you and your wife are making a combined $120,000 a year,
Yeah.
and then you took another $300,000 out of the IRA, your income for that year is $420,000, which means you're over probably that 250, 280 threshold, and you're getting taxed at that top marginal tax rate of 34%.
And you will not get a thank you note from the IRS.
No, will not.
Yeah.
They should. I actually put that in the
Well,
request.
and real quick, so for if any of our listeners have inherited IRAs, were the old ones grandfathered in to still?
Yeah.
So it's just new ones moving forward.
The new ones going forward. When you
Okay.
die after January 1, new rules apply.
Okay.
Gotcha.
So if you have an inherited IRA, don't freak out that you just your previous strategy.
Right.
Is shot.
So if you have parents or people that have an IRA that want to give it to their kids, and the parents want to make that money last longer, right now they only have 10 years. That money can only last 10 years. You have to take your RMDs out of it, your standard distributions over a 10-year period.
No more RMDs.
That's right, no RMDs. I'm sorry. It's just a 10-year period. It's
10 years. Here it is. Take it when you want it.
Take it when you want it, and then that gets taxed at that income tax rate. Is there a better option? Or what if mom and dad know that the kids are they have some kids who might have some issues, or they might get a divorce, or they might have some substance abuse issues, right? I mean, those are always concerns for parents that might pass, right?
Exactly. And even though the Secure Act is not the culprit of it, the real issue we have to be smarter about is our inherited monies are subject to taxation, but they're also subject to our children's judgments. And so currently there's several issues going on. So if I leave my $1 million IRA to my son and he gets into some type of lawsuit where there's a judgment and that judgment reaches in to take part or all of that money out of that IRA, he loses that money in the IRA and then he has to pay the taxes on it. That has nothing to do with the Secure Act. That is 100% to do with what happened in 2014 in a Supreme Court decision with unanimous consent where the question was finally answered: are inherited IRAs protected from our children's judgments? And it was a bankruptcy case that actually started back in 2010, but this case got to the Supreme Court in 2013, and the two things that the Supreme Court primarily focused on in this case: the daughter filed bankruptcy. She had about a $300,000 IRA that she had inherited from her mom back in 2001. She elected stretch option. Smart play.
Yep.
She was working, computer
job.
programmer. I mean, everything was the way it should have been done. 2010, she was flat broke, her and her husband. They filed BK, and the BK court initially said that inherited IRA is not going to be part of this $300,000 judgment recovery.
Yeah.
It's exempt. Well, the person who was trying to get their money said, no, I'm going to appeal, and went to the appellate court, and the appellate court said, not so fast. Why can't this guy get paid? And so they made their issues. It went up to the Supremes, and so we finally had a case about inherited IRAs get to the Supreme Court for a decision. And the two things the Supremes focused on: did the daughter create the inherited IRA? No. Did the daughter fund the inherited IRA? And the answer was no. And there are a few other technical issues here, but those were the two biggies. And from that, the U.S. Supreme Court, again in a 9-0 ruling, which is like so rare it's not funny.
Right.
But in that ruling, they concurred that this IRA is not an inherited IRA. It is a property settlement that's untaxed.
Okay.
So
for judgment litigators, the door's open.
Yeah.
And just to clarify on the math too, so for simple math, if $300,000 is in there, you pull that out.
Lost it in a lawsuit.
Taxes aren't taken out of that $300,000. You then go file, and out of your personal balance sheet, they say, okay, well, it seems here that you made $300,000.
Let me take you one step further for the technicalities of it. So you're the IRA custodian managing gazillions of dollars for
Right.
XYZ company. You get the first ever letter from the Supreme Court of the United States saying, cut a check to pay this judgment. There had to be an army of lawyers present that day.
Oh, absolutely. Yeah.
So the IRA custodian obeyed that court order, cut that check, and then that IRA custodian on January 1 of the following year issued a 1099-R
Right.
to the IRA plan owner. And that's the challenge we have today. It has nothing to do with the Secure Act. This issue started back in 2014 when the Supreme Court said these inherited IRAs bear no level of asset creditor protection for our children, and it was a bankruptcy case. There's been a subsequent case involving divorce law in the Eighth Circuit Court, which also ruled for people that were alive that they had to pay a judgment because they didn't follow the rules of the quadro and stuff like this. The point is this. The Supreme Court has now made it clear inherited qualified plans are eligible for judgment recovery. So the question becomes, what future Supreme Court cases are going to present themselves that more clarify this? And then when will our first case involving ERISA assets like 401ks, 403bs, et cetera, finally get a court order identifying that, yes, even those, we know the door is wide open now.
Right. Yep.
So for good planners, what I'm seeing is that the sharp attorney, the sharp accountant, the sharp financial planner are having these discussions with these folks who own these IRAs with $400,000 or $500,000 or more. They're having this discussion about, okay, we know you don't want to take much out of this while you're breathing because you don't want to pay the tax, but when we leave this IRA to our children, is there a way to leave it to them in such a way that, one, they don't lose it in a judgment,
right?
And two, is there a way to leave it to them in a way where we can do good for them? And if there's a way to leave these IRAs to the kids with less tax,
also,
which is always, there's a way to leave my IRAs to my children with less tax. Well, yes.
So what we're talking about, just to make sure, is we're trying to stretch it out as long as possible to give the children, the inheritors, a income stream from that IRA. We're trying to protect those assets, and if we can stretch it, we also, that basically means they pay less tax on that IRA.
Exactly.
Correct. They let it grow more because of interest. Hopefully it's invested correctly. And then so they're paying less tax, stretching it out, and it's creditor protected.
Exactly. And so the strategy that I've been using, which is chapter 17 of my book, I call it the Give It Away Twice plan. It basically is a unfunded charitable remainder trust.
Okay.
Okay. It's a special type of charitable trust, and it doesn't require any administrative work or anything while you're alive. It's just an empty bucket sitting there ready to receive your IRA, your 401k, whatever, any kind of qualified money. In fact, any kind of asset can go to it, but this is a great play for qualified money. And so the trust is set up. I name my children as the income beneficiaries for up to 20 years.
Okay.
I pick out the charities that I like.
Yep.
I reserve the right to modify the charities in case one of them goes weird on me and I don't like them anymore.
Yep.
So I have this empty bucket, the Charitable Remainder Trust, specifically designed a certain way. And then the kids are the income beneficiaries for 20 years. So let's just say I put $1 million in my IRA at death. We have no tax on the transfer from the IRA to the charitable trust because the charitable trust is tax exempt. All right, so we're winning there. My children, let's just have one child to make this simple math. So I have one son. He's going to receive the income distribution from that $1 million. It's going to be professionally managed. Let's call it a 5% payout. So my son's going to get a check for $50,000 a year for the next 20 years.
Yep.
That's $1 million.
Like clockwork.
Like clockwork.
Yep.
And since I'm giving him $50,000 over time instead of $1 million all at once, which would be a $500,000 tax bill here in California, I'm actually getting some tax efficiency here. The guys like it because I worked hard for this IRA and my son gets to inherit the IRA and pay less tax. Okay, I get that. Mom likes it because mom knows that from the grave that her son is going to be taken care of for the next 20 years, regardless of the mistakes, the boo-boos, the bad one that he married, whatever.
Right.
He's getting a check for the next 20 years. And mom and dad love the fact that every time little Johnny gets that check deposited in his account, he's probably going to get to remember mom and dad.
So how's that check? How is it taxed when it goes into his account?
Now, he's got to pay taxes on it, and it's ordinary income.
Ordinary income, okay.
But because we're stretching this over time, to use that word, because that is a word some people are used to,
right.
We're basically stretching the payments over time, which is more tax efficiency.
Absolutely.
And then at the end of the 20-year trust, a big fat check goes to one or more charities.
Right.
In effect, you gave this $1 million tax disaster that also has huge issues in respect to basically asset protection strategies for the kids in case they're business owners, lawyers, accountants, whatever. It helps us do something better.
Okay, so dad's happy that the money's getting taxed less. Mom's happy that she's given money to her kids. And it's kind of sheltered, and she's just got almost like a pension. But another thing that for the beneficiaries, that's kind of awesome is if you all of a sudden come into an opportunity where you're like, hey, I'm going to get $50,000 for 20 years. That might be your catalyst to be like, well, maybe I'll semi-retire. Maybe I'll step back, and that's how I pay less taxes. Is I just work less and I play more.
Exactly. With good planning by mom and dad, they can actually create. I hate to use the word charitable pension plan because there's no such thing as a charitable pension plan. but I'm taking the worst possible asset that has the most tax, that goes to my children with the highest litigation exposure, cost to my kids, and turning it into something that's a guaranteed income stream, that's safe from lawsuits. And now the kids get to go, okay, I have supplemental income here. Maybe we might name the grandkid as a beneficiary instead of the kids. I mean, there's a lot of flexibility here to
Right.
accomplish all types of issues. But there are some rules on what you can and can't do. It is a little sophisticated. Yes, I do meet with lawyers to train them on how to do this because most attorneys don't know how to customize charitable trust.
Oh, you can't get this on LegalZoom? You just don't hop on?
Go right to
Ah,
LegalZoom. There it
Stop
is.
Googling
Click.
that, Mark. We
Yeah.
can't do it on LegalZoom. Sorry.
Yeah, there's a place for LegalZoom. There is, but this is not one of them.
Right.
And in fact, when we poll attorneys every couple of years, the advisors in philanthropy and a couple of other organizations poll the attorneys to ask, how many charitable trusts have you done this year? How many have you done in your entire career? Nationwide statistic is 1 out of 50 attorneys will do one charitable trust their entire life.
Wow. So what you're saying is that charitable option is very underutilized? Is that the right way to say it?
Way underutilized.
Okay, yeah.
And it's sad because it's one of the best pieces of the tax code. At least the Charitable Remainder Trust is used a bit more than the Charitable Lead Trust. The Charitable Lead Trust is another great tool. Nationwide, we have less than 7,600 Charitable Lead Trusts in place for the entire country.
Yeah.
So these things are heavily underutilized. And I think a lot of it has to do because the consumer hears the word charitable and they immediately go, well, because I've been trained my entire life to give money to my favorite charities, get a tax deduction, and then when we pencil it out on my 1040, I didn't make money, they immediately go, charitable tax planning is a way to lose money.
Right.
That's only for poor people who don't have good enough advisors. The reality is, properly
Yeah.
structured charitable tax planning strategies with other tools, you're either going to break even or make money.
Okay. Yep. Gotcha. So kind of going back to the Secure Act, which we've been talking about. So we kind of talked about they raised the RMD age from 70.5 to 72.
Yeah.
They took away the stretch option.
Stretch is gone.
Stretch is gone. But we have a solution, right? And kind of what do you call it, Ed? You call it what do you call it in your book? The double.
Give it away twice.
Yeah, give it away
Give
twice.
away twice.
Yeah, the
which
give away
was
twice.
The IRA to CRT.
But what that kind of does is, again, it works similar, right? But you're stretching that out over 20 years. You're basically setting up again, we're using terms that people understand. It's setting up a charitable pension plan. That's not what it's called.
Yeah.
There's no such thing as a charitable pension plan, but it's basically setting that up so that you can stretch those dollars out, that $1 million, $50,000 a year for the next, long period of time, so that people can get that, so the beneficiaries can get those dollars for 20 years, and obviously pay a lot less tax, right? Because they're getting a lot less dollars taxed at that high marginal tax rate.
Yeah, and part of the plan here is to give the kids a nice income stream, pay the IRS less, and give a pile of money to worthy causes that can really solve problems in this nation.
Sure.
3 times more effective than a tax dollar in the hands of the U.S. Treasury or the
Yep.
California Franchise Tax Board will ever
Correct.
be able to solve.
So it's a win-win, really. They get
Yep.
money for a long period of time. You pay less
Yep.
taxes. Your kids get an income stream, and money goes to charity.
And you're helping the country
And you're
more
helping-
than just being a
And I was-
taxpayer.
and I know, like, usually people have, like, I wish the government would do more of this. Everyone has their own, like, pain point where they're like, I wish there was more funding for this. It's like, here's a good opportunity to where it's like, hey, if you think you go do it. Like, you can
Right.
go help those causes. I mean, whatever it is that you're passionate about, I mean, as long as it fits in with the strategy, like, step in between, that issue.
And
of
it's
the
a more
government.
efficient
Yeah.
dollar because it's going direct. It's not going through some mechanism. It's going direct to the charity so they can go fix that problem.
Let me hit your pocketbook.
Yep.
When you pay $1 in tax, maybe 27 cents of that dollar actually does something for this country. Over 70% of your dollar is eaten up in fraud, waste, and abuse, budget deficit payments. In other words, things that do nothing for this
Interest
country.
payments. Yep.
I give $1 to a worthy organization, 80 to 95% of that dollar is effectively employed to do something for
Yep.
this nation.
Yeah.
Even our dumbest Congress people understand this, and Lord knows we have plenty of them. That's why the tax code's 80,000 pages.
Right.
Yeah.
Yep. So, listeners, guys, gals, everybody listening, use charitable trusts. Talk to Ed. Check out his book, Tax Secrets Made Simple. Learn these things. They're all in there. Or we'll give you Ed's contact information kind of at the end. But make that happen. Cool. So let's keep going on the Secure Act. So we talked about the RMDs. We changed. We talked about the stretch option. What else is in there?
You can contribute to your IRAs after 72 if you're still working.
Oh, good. Yep.
That was a good thing.
Yeah.
Because we have a lot of people who work past 70 now.
Yeah.
And they're just like,
70's the new 60 is what I heard.
That's exactly right. And so there's many things. There's just so many great things in the Secure Act. It's a litany of things. I truly can say I haven't seen anything that was disappointing.
Yeah. Good job, Congress.
Yeah.
We don't say
Wow.
that very often.
I
Wow.
know.
Good. I can't say good job, Senate. I don't know the senators always, but good job, Congress.
Yeah. Good job.
Yeah. Okay. Anything else in there that we really need to hit on the?
There's a few things for people with disabilities and stuff.
Okay.
So if you're disabled, you want to ask about that. If your child
Mark,
disabled.
make sure you listen.
Absolutely.
So there's several little nuances in here, some things with 401ks we can do better with annuities and stuff like this. So there's lots of great little nuggets in there. But the big ticket ones, RMDs are now 72.
Sure.
The inheritance is capped at 10 years. You can continue putting monies in your IRAs post 72. The qualified charitable distribution rule at 70.5 stayed the same. Up to $100,000 per year can go from your IRA straight to charity. And I would highly encourage you that if you're giving to charities and you're not having to attach a Schedule A to your tax return because you're not claiming more than the standard deduction for your filing status will allow, I beg of you, use that qualified charitable distribution rule to distribute money direct from your IRA straight to charity if you're over 70 and a half. That is a tax play that is just a no-brainer.
Yeah. Free tips, people.
Yeah.
Come on.
And
Use
then,
them.
because we want to go into a few more like tax strategies as well. I know you had mentioned, the difference between donating cash versus donating stock. Do you want to touch on that strategy as maybe like if people are scrubbing through with their financial advisor on like, hey, where can we be more tax efficient? Like, what are some good opportunities for people there?
That's a great one. And in fact, most people never even consider this. I call it the law of primacy. I remember when I was going to church in Mount Carmel, Davil, Alabama, where I was raised. Did I mention Roll Tide? And
I thought it was War Eagle. I get him.
War Eagle. No, that's the chicken school down the road.
Ooh.
And so I remember being 5 years old, and Miss Margaret Keith, God rest her soul, she was our Sunday school teacher, and she would help us learn at 5 years of age the importance of tithing. And you remember getting the little white envelope, and you'd write your name on it. And if you didn't bring a nickel or a dime, this is back in 1965, when a nickel actually bought something. But if you didn't have a nickel or a dime to put in the little white envelope when you're 5 years old, Miss Keith brought one for you. And so we learned 5 years old, you fill out the envelope, you put the nickel in, you lick and lick and lick the envelope. And you lick all the stuff.
Because the glue tasted good back
then. The
then.
glue tasted good when you're 5. And we learned how to tithe wrong.
Yeah.
Right off the bat. But it's the easy way to tithe. It's you stroke that check, you pull out that wallet. It's right now easy. It's a wonderful thing. And for small gifts, I think it's a beautiful thing. But Mark, getting back to your point, if I'm going to be a donor, whether it's tax efficient or not on my tax return, is there a smarter way to take advantage of the IRS? And the answer is yeah. So let's pretend that 10 years ago, we bought some stock for $10,000. The stock did well. The first 3 or 4 years, it grew to $50,000. But after year 4, it kind of petered out. It just became flatline.
Yep.
No more upward growth. But any minute now, it's going to start growing.
Maybe. Any minute
And
now.
for the next 10 years,
Yeah.
any minute
It's
now.
gonna
Start.
But
I own a couple of those stocks.
But I'm not going to sell that stock because I'll have to pay capital gains on that $40,000 of growth. I bought 10, it's worth 50, 40,000 gain. Oh my gosh, look at the tax bill. I'm not going to sell. I'm just going to set it. When you stop and look at the lost opportunity on the growth, I've been sitting on that piece of crap stock now for 6 years, but I'm not going to sell it because of the capital gains tax. Are you kidding me? So whether it's a 50,000, 5,000, 500,000, don't worry about the number. Focus on the strategy. I've made the decision to give my church $50,000. The law of primacy, because I learned when I was 5 years old to stroke a check. I whip out that checkbook, write the name of my church, favorite charity, $50,000. I turn that puppy in. I get to claim it on Schedule A, line 14, my favorite line. Claim it as a tax deduction.
By the way, we just quoted lines on a tax return, people.
That is something I've experienced with Ed. Is sometimes he'll either say the line or the actual tax code, and I'm like.
So if your CP has any questions, you can tell him just look at line 14.
Line 14.
Line 14 is the most powerful line in your entire tax return if you don't like paying taxes.
I've always said that. Line 14.
Yeah, there you go, line 14. It used to
Trying
be
to tell
line,
my son that last night.
it used to be line 18 till they changed the forms 2 years ago. All right. So
I knew that.
I
Yeah.
write that
They have
$50,000.
forms.
Well, there's a lot more forms now. So I write that $50,000 donation on Schedule A, cash, line 14. It comes over to my 1040. It's more than my standard deduction. Therefore, I get to claim the larger. Schedule A is larger than the standard deduction. Yay.
Right.
Okay, that's cool. What if, remember that block of stock I bought for $10,000 10 years ago and it's worth 50? What if I gave the $50,000 block of stock to the church? Okay. Well, the church has to have a brokerage account to receive the stock, and this is where these guys can help your church or nonprofit set up a brokerage account to receive it. So we donate that $50,000 dead on arrival, been nothing for the last 6 years, piece of crap stock to the church. The church does not care if it's a piece of crap stock. They're going to convert it to cash.
Yep.
And now they have $50,000. So in the eyes of the church or the charity, whether it's a cash or stock donation, they still have $50,000.
Yep.
And to the untrained donor and to the untrained advisors, including the accountants, we initially just look at the tax return. Well, it's still $50,000 ends up on Schedule A, whether it's cash or stock or real estate or whatever. And most people right there just assume that it's the same.
Yep.
It is not the same. Remember when I gave the church $50,000 cash, if I'm in the maximum tax bracket, and let's say I'm making $1 million a year to make the math easy to understand, that means my tax bill is going to be $500,000 here in California. If I make a $50,000 donation, that means now I'm paying taxes on $950,000 instead of $1 million. It's a $50,000 donation.
Correct.
So now my tax bill went down $25,000. I got to pay taxes on $950,000.
Correct.
So I reduced my $500,000 tax bill down to $475,000. So in effect, I spent $50,000 cash to buy $25,000 in tax savings. And most people go, got it. I gave the church $50,000 worth of stock, bought me $50,000, $25,000. It's the same, isn't it? Nope. Remember that $50,000 block of stock that I gave the church? What did it cost me?
10,000.
10,000.
So I just gave $50,000 of value to the church that cost me 10.
Right.
I get to claim that on my tax deduction. I just made $15,000 off the IRS in addition to my tax savings.
Yep.
Wow.
Because you're not paying the capital gains,
Not paying the cap gains.
and I get the reduction.
I get the same fair market value tax deduction as cash because the exercise was cash or stock.
Yep.
I'm giving the church stock that appreciated, but now it's poorly performing. This works with real estate too. I got the same tax deduction value. The only difference is when I gave $50,000 cash to the church, it cost me $50,000.
Right.
I gave $50,000 worth of appreciated stock. My cost is only 10.
Right.
Bring the tax deduction forward. I netted an extra $15,000 off the tax man.
Why doesn't everybody do that, Ed? I don't know why.
I did this to a group of attorneys and accountants in Denver last year, and
Does heads explode?
they actually had me back up and do it one more time. They all knew that made sense, cash, stock, but they never realized that by giving the appreciated asset, they actually made money off the tax code.
And we have some really smart listeners to our podcast, so they probably got that first go.
Yeah, that's exactly
probably.
right.
Yeah, the attorneys, that's not
But
shocking.
I'm gonna
it's
replay.
not shocking that the attorneys didn't
I'm
get
gonna
it.
replay this section a couple times so that I finally catch up.
I think even our sound guy, he got that. Levi did. He totally got that.
But it gets back to that law of primacy.
Yeah.
Once we learn how to do something one way, whether it's right or wrong, good or bad, tax smart or dumb, we're going to stay in that rut until somebody comes along like you guys and says, there might be a better way.
Yeah. Perfect.
Which then we followed up with talk to Ed.
Yep.
Yeah.
All right. So we're going to kind of wrap the episode up there. As always, we always end it with our speed round, which are always kind of fun. So, Ed, are you ready to go into the speed round?
Oh, my gosh.
So
Yes.
for the speed round, since you're a tax guy, I want to know from you who has probably been the single most influential person to the U.S. tax system in the past quarter century.
My favorite, Dr. Art Laffer, Laffer. So if you really want to learn about economics, go back to school, spend 4 years in a classroom learning about economics. But if you've got 4.5 minutes to spare, type in Dr. Art Laffer's name into Google. He's got a 4.5 minute quick clip video that will teach you more about economics and tax code than you will ever learn in college. It is my favorite video. He used to be one of the advisors here in California to Reagan and to even Schwarzenegger.
Okay.
And then Dr. Laffer was so smart, he finally figured out, get the heck out of here, and he moved to Tennessee.
Yeah, taxes are cheaper there. Yeah.
Oh, yeah. Yes, but he's brilliant. He's there's several good ones out there, like Harry Dent and several others, but Dr. Art Laffer, he's probably my favorite guy that's probably done more to help people understand the tax code and for Congress to understand the tax code.
Sure.
He's a good
Congress isn't that smart. They only can watch a video for probably 3 minutes. They probably don't get to the end
one.
even.
No, they won't get it. But Dr. Laffer, you'll laugh. You'll get a good chuckle out of him. 4.5 minutes.
Yeah.
For everybody, we'll put that link on the website.
Yeah,
and
absolutely.
On the podcast, so you can look that up.
Yeah.
Okay, perfect. If you could change one thing in the tax code, what would it be, Ed?
Eliminate the estate tax. There is too much time and money and basically lip service on the estate
Yes.
taxes. The reality is less than 1% of the nation is subject to estate taxes. So
Thank
why
you.
do we make a big deal out of it?
Yes.
Let's just get rid of it. And this is why the IRS would love to see us get rid of the estate tax system totally and then change what's called the step up in basis rule. For my house, my cars, my privately owned stock, everything else I own, in other words, my non-qualified monies,
Right.
they all get a step up in basis when I die. They transfer to my kids, zero tax.
Yep.
They're good assets. The bulk of the nations on this planet don't do it that way. The bulk of the nations have what's called a modified step up in basis rule, where a small portion of the assets when mom and dad die do get an adjustment to be a zero tax transfer, but they put a capital gains tax on the rest of the estate.
Okay.
We actually did this in 2010. Remember when we used to have a tax code in 2009 and we were going to get a new tax code in place before it sunset? We didn't. And then we had to go back to modified income, capital gains, estate tax rules for 2010, while
Yep.
Congress did get a new tax system in place for 2011.
There was something going on there. I don't remember what it was. Great
So we've
financial
tested
crisis.
this concept and it worked. And so let's just get rid of estate taxes and let's just go to a modified step up in basis rule. Now, I'll be the first one to tell you the accountants go, how do we even begin to defend this to the IRS as to
Sure.
what the basis is?
Yeah.
So there's some technical issues here, but it's not a foreign issue. It is an issue that globally is done more than anything else.
Yeah.
Yeah.
And for all your counselors, and quit complaining. It's just more work for you. So
Bill them more.
it's a good idea, Ed. And
Yeah.
yeah, bill them more. There you
Yeah.
go.
Okay, so I'll ask this one since I'm on the outside of this one. So should Josh have gone to the Air Force rather than the Navy?
I've never flown with Josh. I don't know how good he is at crashing and flying.
I have asked him to sneak me onto one of the planes, and he has yet to do it. But
Yeah.
I get in trouble.
Just put on
Boss.
somebody else's flight suit.
That's
Gotta-
right, yeah.
Gotta get rid of your beard.
That's
you'll
what
be
I
fine.
said. I was
Yeah.
like, I'll just slip in there.
We did have a student do that in San Diego in 2011. Long story. Don't do it.
Don't
Big
do it.
trouble. Yeah.
Yeah.
All right. For a family-run business, what simple piece of advice would you give them?
In today's market of M&A, granted, we've got the coronavirus and all this stock market disaster stuff going on, which at some point will heal itself. The biggest problem that I see with business owners is they don't run their business as if it's for sale every day. When we get to a market like we have today, you've got so many business owners who have now decided, hey, I'm ready to retire.
Sure.
I made it through 2007, 8, and 9. I was able to lick my wounds. We survived. My business is running good. Now I'm 60, 65, 70. It's time to liquidate my business. And the reality is, you've got to think about selling your business being like selling a used car. I don't care how shiny it is on the outside of the building. When you lift that hood and you start looking at the engine and the transmission, if it's not running perfectly, you're not going to get full value for your business.
Yep.
And what I mean by this is not having good accounting, not having good culture, not having middle management that can take over, not handcuffing your key employees. In other words, the things that anybody who's willing to even buy your business, let alone at the price you think it's worth, would even consider having a discussion with you.
Yep.
1 out of 5 businesses actually sell that are listed for sale.
Gotcha.
So run your business like it's for sale every day. This way you're prepared.
When it
And you
happens.
truly need 2 to 3 years to get your business ready to go to market if your goal is to sell at top value.
Okay.
If you don't care what the business sells for, keep doing what you're doing.
Yeah.
Yeah.
There you go.
Don't clean up your books later. Clean them up now.
Yeah.
Right.
Awesome.
one.
Last one. So, not sure, we're going to post this in a couple months from now, but, for our listeners, when we're recording this, this is the coronavirus is,
The Dow was down 10% today, so
yeah.
that's
so,
what day it is.
I think I looked up flights to Hawaii for $99 last night.
Yeah.
Flights are cheap right now. If you were saying, if you're going to take advantage of these cheap flights, where's the first place you're booking a trip to right now?
Probably Hawaii.
Probably why.
Nice.
Yeah, I was actually looking at booking trips to Atlanta. Normally, my trips to Atlanta are about $500 a pop.
Yeah.
Yesterday they were $250.
Where would your wife want to go?
Hawaii.
Hawaii. Okay, there we go.
Oh,
Okay,
yeah.
that's all that matters. Your opinion doesn't count. Ed.
Mine doesn't count.
Yeah, just like mine doesn't count. Awesome.
I'm in that
Okay.
boat as well.
Yeah. So we're going to wrap the episode up there. Thank you, everybody, for listening. Ed, thank you so much for being here. That was a great topic on the talk on the Secure Act, some tax strategies on how to stretch those IRAs out, take advantage of the tax code, and just do something a little bit different to help people out. Any kind of closing thoughts before we go?
Only mom and dad can put the strategy in place to fix the IRA before they die.
Okay.
This is not something you can fix after mom and dad die.
Right. Yep.
Proactive planning has to be done first.
Proactive plan. We've said that a lot of times.
Yeah, I was gonna
Proactive
say,
planning.
man, that sounds so familiar.
Yeah, like you said that before.
Yeah.
Yeah.
Well, I mean, my closing thought is absolutely check out this book. I mean, wealth of knowledge, and I mean, just even going on the charitable planning, like, things like, hey, would you rather help? Would you rather have, what would you say, 20 cents? 20 cents of the tax dollar go to help the country, or would you rather have 85% go to help the cause you want? Look at incorporating more charitable planning into your, overall financial strategies.
Yep. Again, it's called Tax Secrets Made Simple. You can get a copy on Amazon. We have a couple copies here, so if you're one of the first people to shoot us an email and ask us for one, we'll send you one of them. You can have my copy because I already read it. So I can't get my son to read it yet, but soon. They're smart.
Yeah.
Ed, how else can we get a hold of you? How else can they check you out and get a hold of you?
My website, olympustax.com. I've also got a newsletter on this I'll give you.
Okay.
I just finished writing it literally this week to try to explain this in more lay terms.
Okay.
And in a comparative chart so you can look at doing nothing versus something. So I'll send that newsletter to you.
Perfect.
And it's real simple, 3.5 pages, easy to read. Remember, I'm from Alabama, so it has to be written simple. And I think
Because you
you'll
went to
enjoy it.
Alabama. Yeah.
Yeah.
Perfect. All right. Yeah.
So thanks for listening, everyone. Be sure to check out our podcast on Apple Podcasts, Spotify, YouTube. You can also visit our website at www.wealthpreservationpodcast.com.
Yep. Hit us up on YouTube, Apple Podcasts. Lastly, anything said here should not be taken as tax, legal, financial advice. Please hire a good advisor, hire a CPA, hire an attorney, hire a financial advisor before you make any decisions. There's no trade recommendations made here, so please seek help before you make any decisions. Thanks, everybody, for listening, and have a great day.